Welcome back to De-Risk Investing. I'm your host, Sarah. Let's start today with a mental exercise. If I asked you to picture the market, what do you see? You probably see a chaotic trading floor, people shouting, red and green lines zigzagging on a screen. You see stocks, Tesla, Apple, Nvidia, the rock stars. But here is a secret. The stock market is the loud younger brother. It gets all the attention. But the older brother, the quiet one, he actually has way more money. I'm talking about the bond market. Depending on who you ask, the global bond market was estimated at over $145 trillion in 2024. It dwarfs the stock market. It controls the cost of your mortgage. It dictates whether governments can build roads. It decides the fate of nations. And yet, for most people, bonds are a black box. They are confusing. They seem boring. But ignoring bonds is dangerous because when the bond market sneezes, the stock market catches a cold. Today on our Investing Concepts series, we are going to fix that. We are de-risking your knowledge gap. We are answering, what exactly is a bond? To understand bonds, we have to leave Wall Street. I want you to imagine you are hungry. You walk into your favorite local pizza spot run by a guy named Tony. Tony makes great pizza, but he has a problem. He wants to buy a new brick oven to expand his business. That oven costs $1,000. Tony doesn't have $1,000, but you do. Tony asks to borrow the money. Now, you like Tony, but you're not running a charity. You want to make a profit on your capital. So, you strike a deal. Tony goes into his office, types up a formal agreement, signs it, and hands it to you. This contract says 3 things. First, the principal. That's the $1,000 you gave him. He promises to give you that full amount back in exactly 10 years. That date, 10 years down the road, is called the maturity date. Second, the coupon. This is the amount he pays for using your money. Tony promises that every single year, he will take $50 cash straight out of the register and hand it to you. That gives you your interest rate on the bond, $50 a year on a $1,000 loan. That is exactly a 5% interest rate. Third, the issuer. That's Tony. He is the one responsible for paying you. Congratulations, you just bought a bond. You are the lender, Tony is the borrower, and that piece of paper in your hand is the asset. For the first few years, this is great. Every year you show up with your contract, and Tony hands you a crisp $50 bill. Life is good. This is why people buy bonds. They want that steady, predictable cash flow. But here's where bonds get tricky. This is the part that confuses everyone. Let's say it's year 3. Suddenly, you need your money back for whatever reason. You can't wait 7 more years for Tony to pay back the $1,000 principal. So you decide to sell your Tony contract to your neighbor, Susan. But there is a problem. Since you lent Tony the money, interest rates in the economy have gone up. Banks are paying more for savings. Mortgages are more expensive. Maybe a new guy, Sal, opened a shop across the street. Sal is desperate for cash. Sal is offering a better deal. If you lend Sal $1,000, he will pay you $100 a year. That's 10%. Think about Susan. Why would she buy your Tony contract that only pays $50 when she can go to Sal right now and get a contract that pays $100? She wouldn't. Your bond is now less valuable. It's inferior. So if you want Susan to take that contract off your hands, you have to put it on sale. You can't sell it for $1,000 anymore. You might have to sell it to her for $900 or even less to make it worth her while. This is the golden rule of bonds. Write this down. When interest rates go up, bond prices go down. Why? Because nobody wants your old, low-paying contract when they can buy a shiny new one that pays more. Conversely, if interest rates dropped, if Sal was only offering $20 a year, your $50 contract would be incredibly valuable. You could sell it to Susan for $1,100. That piece of paper is a bond. It's a trade-off between guaranteed income and the changing winds of the economy. Now, Tony and his pizza oven are a modern example, but the idea of the bond, it is ancient, older than the stock market, older than Rome. We have to go back to 2400 BC.
to the ancient city of Nippur in Mesopotamia, modern-day Iraq. Back then, temples acted like banks, and the very first known bond wasn't for dollars or gold, it was for grain. The principal was a guarantee of grain payment. The interest was paid from the crop itself. It was organic growth, literally. You lend the grain, the farmer grows more grain, and returns a portion to you. But there was a catch. These were just loans. You couldn't really trade them easily. To turn a loan into a market, we have to jump forward to 12th century Venice. Venice was a powerhouse, but power is expensive. The government needed to fund wars, so they issued the prestiti. These were war bonds paying 5% yield, but the Venetians did something revolutionary. They securitized the debt. They allowed citizens to buy and sell these loans to each other. If you needed your money back, you didn't have to wait for the government to pay you. You could sell your claim to your neighbor. Suddenly, the debt of the nation had a price that moved up and down. It was treated with complex math, very similar to modern quantitative finance. While the stock market wouldn't show up until the Dutch East India Company in 1602, the bond market was already hundreds of years old. It survived the Black Death. It survived the collapse of Lombardy banking. It is the bedrock of finance. So, we know what a bond is. We know it started with corn in Mesopotamia and got securitized in Venice. Let's end with a common misconception. People think bonds are risk-free. They imagine bonds are like a warm blanket or a sleeping golden retriever. Safe, cuddly, nothing bad happens. Here's the reality. If you buy a bond from the US government, sure, that is pretty safe. They can print money to pay you back. But if you buy a junk bond, that's a bond from a company that is struggling. Sure, they offer you a massive interest rate to tempt you, but make no mistake, that is not a sleeping golden retriever. That is a golden retriever trying to ride a unicycle on a tightrope. If the company goes bankrupt, if Tony's Pizza burns down, you don't get your principal back. You don't get your coupons. You get nothing. Just because it's called a bond doesn't mean it's unbreakable. It just means you are first in line to get paid, if there is any money left with the borrower. Bonds are the ballast of your portfolio. They provide income. But you have to respect the mechanics of price and yield. If you want to see how these concepts play out in the real world, then do check out our other episodes this week. So, understand debt, and you understand a big part of the world of finance. That's all for today's episode. This is De-Risk. Until next time, happy investing.